Hello, I'm Bernard Hickey from Interest.co.nz and welcome to a special investing report brought to you in association with ASB. Today we're going to have a look at the latest report from the Reserve Bank on bank safety. Every 6 months the Reserve Bank comes out with its Financial Stability Report, where it reviews the safety of banks, the performance of the financial system and how stable the whole system is. Well, it's been a rough couple of months, but the Reserve Bank has come out with a clean bill of health for New Zealand's banking and financial system. It's warned that there will be higher debt charges to come for the banks, but that the banks have plenty of capital to handle it. The Reserve Bank says that bad debt charges are still low by historic standards, and it points out there's less than $1 in every $200 which is impaired. That's less than 0.5% of the bank's loans are in trouble. Yet the banks have capital reserves of over 8%. It's actually the best since March last year. That's because all of the banks have been raising capital quietly earlier this year to make sure they've got a big buffer to handle any downturn. And the Reserve Bank has been quietly telling them this is a good idea to do. Meanwhile though, households continue to be the most stressed they've ever been, with high debt levels and also relatively high interest rates for most people. But when you look at it closely, there's still a relatively low number of New Zealanders who have very high loan-to-value ratios of more than 80% or so, and very high debt servicing ratios where they're paying more than 50% of their take-home pay in mortgage interest costs. And the Reserve Bank's done a bit of analysis on what might happen if house prices were to fall 30%, what might happen if unemployment was to rise to 9%, and what might happen if we saw a rise in interest rates of 300 basis points. So it's done some stress testing there to see how well New Zealand households can handle it. It turns out currently we've got 0.1% of households in this position with more than 80% loan-to-value ratio and more than 55% debt servicing ratio. And if all three of those worst-case scenarios happened, then that percentage would rise to 3.6% of all households, or 6.9% of debt. The chances of all three of those things happening is quite low, and even if it did happen, that's not a disaster for the banking system. There's plenty of capital there to handle it. I'm Bernard Hickey. That was a special report on investing for Interest.co.nz, brought to you in association with ASB.